Let's kick things off with Steve Liesman live in Jackson Hole, Wyoming for us. And Steve, we certainly got a big dose of Fed speak today, at least.
Yeah, we did. We had the first officials to speak at this annual gathering in Jackson Hole beneath the Tetons, but they didn't necessarily tell the markets what they wanted to hear about the need for deep interest rate cuts in the months ahead.
I didn't think the cut was appropriate necessarily, but I went along with it to get back to neutral. But I'm on hold right now. My forecast is just a hold.
My sense was we've added accommodation, and it wasn't required in my view. I think we're in a good place relative to the mandates that we're asked to achieve.
Now, Dallas Fed President Robert Kaplan said he wants to avoid cutting rates if he can, but he says he's open-minded about rate cuts. He also seems concerned that the big decline we had in bond yields is sending the Fed a message that it should not ignore. The comments from the three Fed presidents highlight divisions in the overall rate-setting Federal Market Committee about where to set rates. 8 of 10 voting members, you'll remember, supported a rate cut, but 2 of them dissented. And minutes of the meeting that were released yesterday show that there's more support for these dissenters from the non-voters. All of this raises the stakes for Fed Chairman Jerome Powell, who will deliver a keynote speech tomorrow at the Jackson Hole Summit. Here's some of the issues that he has to deal with in deciding what to do with rates. First, he's got to navigate between U.S. growth at trend, but global economies are weak. Consumer strong, manufacturing slowing. FOMC members divided between the hold and between cutting interest rates. So, guys, we have that speech tomorrow morning. Not a set of easy choices in this bucolic setting we have, and I'm wondering whether or not he uses that term mid-cycle adjustment again. Melissa?
Yeah, because that really didn't roil the markets the last time around. But I'm wondering, I mean, knowing now what we know from the FOMC minutes that the committee was so divided over the last decision, or at least the reasons behind the last decision, it almost seems like every single interview you do out there, Steve, is even that much more important because you've really got to take the pulse of each individual committee member.
I think that's right. And I think we're learning now that at that press conference, what Powell could say about the need for additional rate cuts was prescribed by where his committee was. And I think we kind of knew that going in, but we certainly learned that more from those minutes, and we're learning it more from these interviews. We have a bunch more interviews coming up, Melissa. If you don't mind, I'll take a second to tell you what we have coming up. Tomorrow we have Loretta Mester from Cleveland, and we have James Bullard from St. Louis. We also have the speech by Fed Chairman Jerome Powell. We'll bring that to you at 10 a.m. tomorrow. The headlines from that as well. We can't, there's no cameras allowed in the meeting. And then later on in the day, we have Mark Carney, the governor of the Bank of England. So we get a whole sort of U.S. and international perspective about where interest rates are going.
Steve, it's Karen. Let me ask you, do you think we'll come away from tomorrow from Powell and Carney with clarity?
You know, that's a good question, and I think the answer is no. And the reason I think the answer is no is because I don't think that the course of policy in the U.S. is very obvious. I was thinking back on other times that the Fed has changed course, cut rates, or hiked rates, and you had unanimity at the board, near unanimity, because the case was pretty easy to make. You know, we are running at trend here. I mean, just step back and tell yourself something. The Federal Reserve cut interest rates at record low unemployment. That fact alone should be enough to say, you know what, these times are different, that it's a new set of rules, and what to do is not exactly clear. And I think you're hearing that. Now, some of you guys around the table may say, oh, the message is confused, the message is muddy, the Fed should be talking with one voice, or you could get this sort of different set of concepts and ideas and opinions out there, and it shows you really how difficult things are to figure out and how uncertain the prospects are for both the recession and for continued growth.
In the meantime, Steve, I hope you get some more time to look at the wildlife. You showed us some beautiful pictures on the halftime report of the bison and the wild horses, and that was much appreciated. It was a nice respite from the markets during the day. Thank you, Steve.
We can run that for you again, or I could go out and go fishing and send you some more pictures of that.
We don't need you in the picture, time. Just the wildlife.
Oh, not me? Oh. Okay. I misunderstood.
Steve, good to see you. Thank you. Steve Liesman in Jackson Hole. All right, so what are we expecting here, and will the markets ultimately be disappointed?
The markets will find something to be disappointed in because we've been waiting for it for the entire week. I think the muddy will be the word of the day. I think he will be muddy. He's got a history of being muddy, and I'm looking for muddy tomorrow, and I'm looking for a sell-off after the event.
Although he is giving a speech.
Right.
He's with a script, in theory, with no cameras around and no Q&A. And that's where Powell really shines. When he's reading off paper of prepared remarks.
And Fed governors have traditionally used this speech, or Fed chairman have traditionally used this speech to usher in kind of new monetary policy. So, Steve mentioned that the Fed cut rates when we have record low unemployment. The other side of their mandate, though, is price stability. And if you look at inflation expectations, they have been plummeting. So if you're sitting there and you're a central banker and you say, how do we not turn into Japan with basically zero rates for 20 years, you have to worry about that. So for me, when I look at the market tomorrow, I look at that speech, what I want to see is how focused are they on the inflation aspect of their mandate versus the unemployment? Because unemployment, check, great job. Inflation, not so much.
Yeah, so isn't it pretty interesting? Your point, BK, is that how do they avoid becoming Japan? And the answer is they don't avoid it. And if you think about what's going on, and what we heard from the ECB, what we know is going on all over the world is that these central bankers are tripping over each other to lower rates. And they're really doing it in a way that is going to make this a self-fulfilling prophecy in a way. Inflation isn't really materially going higher. So you can talk about cutting rates at record low unemployment. If inflation's not going to budge, then we got a real problem here. And if Tina, equities are the only game in town here because rates are going lower, ultimately that's going to be a huge problem because, listen, we talked about retail sales last week. We talked about consumer spending. 70% of our GDP is consumer. It feels like the global economy is it just is
resting on the
it's resting on the U.S. consumer's shoulders. And when you look at that data and you go back 20 years, the data falls off when the data changes and then it drops pretty hard. So I guess my only point is the stock market's going to sniff out a recession. You talk about inverted yield curve all you want. We have no idea when a recession's come, but the market's going to be down a lot, a long time ahead of the recession or when we're able to call 2 consecutive down quarters in a row.
So it's not the 18 to 22 months that our friend
doesn't matter.
Tony Dwyer
I mean, it's backward looking at that point.
Yeah, well, that's where the recession actually hits. Is 18 to 22 months later, but the market can show. But I wonder why. And I know Karen wants to jump in here. But how come the U.S. flash PMI didn't come up on any of this? It's a 10-year time span before it got back to below 50. What does that mean to Esther George? Anything? Anything? I mean, this is when you start to see the hawks that were hawks in October, and now they're hawks again. It starts to feel like they're robotic and on automatic pilot.
I don't know. I guess you see a lot of mixed data, right? The president talking about this is the greatest economy ever, right? This is fantastic. And we need to cut rates 100 basis points, and we need maybe a payroll tax, maybe we don't. I don't know. To me, I don't know how much the Fed feels they need to fight the tariff war. It shouldn't be in their mandate, but yet somehow it seems to be, and I don't know, that kind of stuff.
Well, to me, if you look at it, you say, why would the Fed need to cut rates, right? It's because other central banks have. And so the financial markets are forcing them in this. But if you look at the economy, to your point, I don't hear a lot of people out there saying, boy, I'd really I would invest in a new plant and hire 100,000 employees if rates were 25 basis
or 50 basis
or 100 basis points lower. Nobody's saying that. So if you're a Fed governor, you're saying, all right, our economy seems to be okay, but the rest of the world has kind of backed us into a corner. And that's where I think when we're talking about stock market, that's the confusion. And I think the stock market traded horribly today.
Yeah, I would just mention, let's go back to July 31st and August 1st. Those were 2 really important days. They may be, we may look back years from now and say those were the 2 most important days in a long time. The S&P had just made a new high, basically above 3,000. We had this 25 basis point rate cut, the first one in 10 years. The market sold off. It kind of got its footing in a little bit because of that mid-cycle adjustment thing, and then the next day the tariff tweet. Okay, those 2 days really interesting, volatile, and we were down I think peak to trough almost 7%. We have not really recovered materially, right? We're still down 3% or something like that. So I guess the point here is that I don't think market participants really know what they want here, and I think when you talk about these PMIs this morning, the U.S. 10-year low and that, Germany disaster, some of the other data, it's going to move around a little bit. I don't think the market knows that it wants bad data that's going to ensure lower rates, because who knows what that means? Are we going to be at 20 trillion and negative yielding sovereign debt soon? And what does that mean? And do the instruments that we have to combat weakening economic conditions, do they still work anymore?